The second hold in a row. That was the Bank of Canada's latest decision, maintaining its key policy interest rate at 2.75%. And while the announcement was largely expected, it can still tell us lots about the state of the Canadian and global economies.
Uncertainty remains high.
That's Bank of Canada Governor Tiff Macklem at his most recent news conference.
The Canadian economy is softer, but not sharply weaker. And we've seen some firmness in recent inflation data. Against this backdrop, we decided to hold the policy rate unchanged as we continue to gain more information on U.S. trade policy and its impacts.
Here to unpack it all for us, as usual, is Scotiabank's chief economist, Jean-François Perrault. He'll tell our Mina Lagaya what it all means for Canadians, look ahead to what the central bank might do from here, and more. I'm Stephen Maurice, and this is Perspectives. Now here's Armina Lagaya.
JF, welcome back as always.
Nice to be on, Armina.
So we're talking at midday on Wednesday, June 4th, and the latest announcement came out just a few hours ago that it's a hold, the second consecutive after April's decision. JF, what's the main takeaway from the decision?
Well, obviously, the main takeaway is the Bank of Canada hasn't changed rates. That's not necessarily much of a surprise. I think the really important takeaway is the bank is still confused about what it needs to do going forward. It's fighting this tension against stronger inflation than expected versus, a weakening economy. And it's still not sure how it's going to manage that as it goes forward. And that led them to keep rates unchanged today with an openness going forward to alter the path of interest rates if either inflation softens or growth softens more.
Mm-hmm. I want to come back to that about what your expectation is for decisions going forward, but I want to dig in a little bit into the latest GDP numbers, because at one point, up until those numbers came out, the predictions were actually leaning towards a cut. And then once that came out, despite the fact that it was actually stronger than expected, but that was actually more deceiving, if anything. So can you help break those down for us? What did the latest GDP numbers tell us, and what pushed the bank to hold?
So the key challenge for the bank, as I just indicated, is, are inflationary pressures going to dominate concerns about weak economic activity in terms of how they think about the outlook going forward? So to the point that you've just made, we received first quarter GDP data late last month, so last week, that showed a little bit stronger growth than expected. Came in at 2.2% quarter over quarter. We'd expected, 1.5, 1.7, so it's a little bit stronger than that. And of course, stronger GDP growth, in some sense, is a good thing because it means the economy hasn't been as impacted by the tariffs and the uncertainty as anticipated. So if the economy is a little bit stronger and inflation is a little bit stronger, then that's a pretty clear path for the Bank of Canada. But of course, when you dig through the numbers, you're right. I mean, there is clearly some strength in exports in the first quarter as Americans largely were importing a range of goods ahead of the tariffs to come. But we nevertheless saw a little bit of an increase in consumption. We saw a bit of an increase in business investment. So that was an important bit of information as the Bank of Canada came into this decision, because prior to that, markets were expecting good chances of a cut. Certainly the other Canadian banks were expecting a cut, except for us, because they were looking to signs of economic weakness and thinking that that was going to dominate the Bank of Canada's decision-making process leading up to today. Now, we know, of course, that even with that GDP report, and in fact, that's what's been driving our call for no cuts this week, has been for many months now concerns that inflation in Canada would be a little bit sticky with the tariffs coming on, with supply chain issues reappearing, with wage growth still being a little bit strong. We were fearful of the risks to upside surprises to inflation. And the most recent inflation report actually had pretty substantial upside surprises. So big strengthening in underlying measures of inflation, which in our mind made it very, very difficult for the Bank of Canada to cut, even if economic activity in the first quarter would have been weaker than expected.
I want to dig into the inflation numbers a bit more as well, because at first glance, as you mentioned, it cooled, but those other underlying measures, core measures, were stronger than expected. Can you break down what's happening there? And also, how much of that increase can we at this point attribute to tariffs and the uncertainty in the economy?
Those are all great questions. So, the headline number for inflation is 1.7%. And that's below 2%, which is the Bank of Canada's target. So if you just look at the headline, you would be right to say there isn't a whole lot to be worried about, and maybe the Bank of Canada could cut. Now, of course, that headline reflects the fact that the consumer carbon tax came off, and that shaved almost 0.75 percentage point off inflation. So if you take that out, inflation was in the 2.5% range. But more importantly, when you look at these underlying measures of inflation, so measures of inflation that the Bank of Canada itself calculates to assess whether or not there is some inflationary pressures in the system. So things like trimmed means inflation, median inflation, those pointed to pretty significant acceleration in inflation in the last month to, roughly 3.1% year over year. So outside of the Bank of Canada's 1% to 3% inflation control range. When looked at on a month over month basis, and you annualize that, those measures were rising at 4.5%.
Oh, wow.
So a pretty substantial inflation shock relative to expectations, which we think, limited the bank's ability to respond to weaker growth. And what's worrisome is that some of that inflation doesn't seem to be related to tariffs at this point in time. It's a little bit earlier for that to show up. So it's underlying inflation pressures, perhaps inflation expectations, which are still very high in Canada, which have been rising because people are fearful of the impacts of tariffs. So that inflation report was not good news for Canadians.
And where are we seeing that? Is it food? Is it shelter costs, which is a really big driver?
It's broad-based. So, the beauty of these measures that the Bank of Canada calculates to assess underlying inflation is they filter out the really volatile stuff. So stuff that's going up a lot, stuff that's going down a lot. And that, depending on the month, that could be food, that could be shelter, that could be a range of things. What we've seen in the last month is the breadth of subcomponents of inflation that are rising more rapidly than 3 or 4% has been rising. So a broader range of goods has been rising in Canada than for a very long time now. And that's another element to be concerned about that inflation report. In fact, the governor talked about today when he was walking through some of the factors that led them to the decision that they made.
So inflation is going up and it's not entirely clear if it's just tariffs and uncertainty that's driving it.
Exactly.
So the central bank gave a partial update on its view for the economy. It can't quite give a forecast at this point because of all the uncertainty or even a clear scenario. But he did use the phrase, and we touched upon it, that the last quarterly GDP numbers borrows economic strength from the future, meaning, to my understanding, that there was a lot of exporting and importing ahead of these tariffs that were threatened coming into place. And so Macklem's guidance was to expect a much weaker quarter ahead. What are your expectations? Because the other thing is that he had two scenarios that he had laid out last time. One sort of more moderate one, where tariffs would be in place but largely negotiated away. And then a second more severe one, where it's a long trade war with severe economic consequences. He said that the latter scenario has less of a probability of happening now. What is your take on what you see ahead? Do you agree? Is that where we're at?
Broadly speaking, yeah. I mean, we know that exports surged in the first quarter, and again, that's because the Americans were buying a whole bunch of stuff ahead of the eventual tariff increase. That happened to some extent in Canada as well. So inventories have been rising as businesses planned for the potential, or had been planning for the potential for inputs to be more expensive. So that, of course, is to some extent borrowing from the future. If you're bringing forward a whole bunch of purchases to avoid paying more for them, you're going to need less of those things because you already pre-bought a lot of those. There's no question the element of front-running the tariffs there. The tricky thing is, of course, sussing out how much of what's going on is front-running and the weakness that will come as a result of that from weakness that's just, plain economic weakness. And we know the economy is weakening. We've got very solid indications that retail spending has softened in recent weeks. Same thing on confidence measures, same thing on business activity. So there's no question that the economy is weakening, even if there is an element of front running that's contributed to strength in Q1. As we kind of put it all together, it looks like we might have a bit of a drop in economic activity in the second quarter. Remains to be seen. We've only got very, very limited data for that so far, but it looks reasonable. It seems reasonable to expect a bit of a decline in economic activity in Q2. But of course, the big thing, as the governor's indicated, is, which makes it very, very difficult to have firm views on anything these days, is the outlook very much depends on what happens in the tariff situation, whether they respect to Canadian tariffs or broader tariffs that the Americans have imposed. And from that perspective, relative to the last monetary policy report, which is when the Bank of Canada last published their forecast, there has been some positive movement. The extremely punitive tariffs of 145% on Chinese imports from the U.S. have been scaled back significantly. There is, you can call it a trade deal with the UK. There's a trade arrangement of some sort with the UK. The Americans are negotiating. So that world in which we'd have these extremely punitive tariffs on the two largest economies in the world, China and the US, that's not the world that we're in anymore. Still a world where there are high tariffs, very high tariffs, but not 150% tariffs.
Mm-hmm.
So from the Bank of Canada's perspective, that does rule out these really nasty scenarios where you have unbelievably high tariffs on extremely large parts of the global economy, and that acts as a drag on economic activity in Canada and commodity prices as well. So you can rule that out a little bit more now than you could, but you still can't rule out a tremendous range of outcomes on the tariff side over the next few months, which of course is what's hampering the bank's ability to make an informed judgment as to where things are going to go.
Mm-hmm. What's your outlook now in terms of the upcoming decisions? Are you still expecting 2 cuts? Some are saying 3 cuts this year.
We're still expecting no cuts. I know that puts us a little bit of an outlier relative to some other organizations, but we are spooked about inflation. What we've seen in inflation is consistent with some of the fears that we had. We didn't want this to happen, but it seems like it's happening. So inflation accelerating to a point where inflation is accelerating more than growth is softening. So that's important from the Bank of Canada perspective, because the governor has made it clear over the last number of speeches that he's done and decisions is because of the nature of this shock, he will assess how far away from 2% is inflation going versus how far from potential is growth going. And depending on which deviates more, that will inform how they choose to go about with monetary policy. And right now, in that horse race, it's clear that it's inflation that's winning that battle, in the sense that inflation is outperforming more than growth is underperforming. And that's contributed to why I think the bank left its rate unchanged today. But we need to see significant reversal of that between now and the next meeting in July for the Bank of Canada to think differently. And we're not sure we're going to get that. So we're thinking that this inflation risk is serious and we'll keep the bank on hold for a while. Of course, another element of uncertainty in terms of how the bank is going to react to things is what is happening on the fiscal front. So we've talked about tariffs and other things, but there is a new federal government. Personal income tax rates are coming down on July 1st. The GST on newly built houses for first-time home buyer under $1 million is coming off. It came off last week. So there are these things that are going to work themselves through the system starting now that will have a bit of an offset, will provide a little bit of a boost to economic activity until we have a budget later in the fall where we would expect, if the economy is as weak as some people fear, that there will be some fiscal measures to right the ship in some sense. So there will probably be some fiscal policy measures that help us out between now and the end of the year if needed. And that, again, would militate for Bank of Canada that's more on the sidelines rather than one that is actively cutting as we try to assess and wait for all these things to happen.
And that fiscal spending has the potential to drive inflation even higher.
Of course. I mean, one of the things that we saw in the pandemic was that the combination of really low interest rates and extremely large deficits contributed to the surge in inflation that we saw that was very difficult to break. Took Bank of Canada at 5% for a while to bring inflation down. Now, I don't think anybody in Canada is thinking about fiscal policy in the way that we thought about it in the pandemic with these $400 billion deficits, but fiscal policy is a powerful tool to boost economic activity, and in the wrong circumstances can have an impact on inflation. Given that we're just coming out of the last episode of inflation that was linked to policy mistakes, I think they can be really cautious in terms of managing that given recent history.
Governor Macklem said today that while there was a consensus on a hold among the governing council for today's decision, there's a, quote, diversity of views on what to go forward, with some seeing a need for a reduction in the policy rate if the economy weakens amid continued tariffs and uncertainty. So it stands a bit in contrast to your view, but is there some rationale behind that view as well?
Sure. That's not at all an improbable view. Like, if growth weakens significantly, if inflation comes off of the highs that we've seen, then yeah, that's a world where you'd want the central bank to cut, and we would hope they would cut. We just don't think we're going to be in a world where, we don't necessarily think we're in a world where that constellation of things is going to work out quite how I think some people at the Bank of Canada thought it might in the way the governor spoke about it. I mean, time will tell. I mean, the governors have also made it very clear that they're data dependent, that they are not particularly forward looking at this point in time because they need to assess these various pressures, what's going on with all the tariff stuff, the fiscal stuff, but also is inflation or growth going to be the dominant concern as they go into the next few decisions. And we hope it's not inflation, but our fear is that it might be inflation.
So Canadians are watching interest rates closely, but obviously particularly homeowners or potential home buyers. So what is happening in the Canadian housing market? What are the ripple effects of all this uncertainty on that? And what is the longer term potential impact of holding interest rates steady for the foreseeable future?
Obviously, folks are waiting to make big purchases like owning a home might be or refinancing a mortgage, typically interest rates have a pretty significant impact on that. So when the Bank of Canada cuts interest rates by a lot, 25 basis points here or there isn't really a big change, but a sequential set of cuts or raises that can have it has had significant impacts on housing markets in the past. Right now, the fact that Bank of Canada is not cutting, of course, isn't going to provide that extra support to housing markets at the moment. But it's not clear if the cut would provide that much support anyways, because what people are waiting for right now is a degree of certainty. Am I going to lose my job? Are tariffs going to cause a recession? What's going to happen tomorrow? So they're waiting on clarity with respect to the outlook more so than, am I going to save 25 basis points off my mortgage if I get it now? Should I act upon that despite some of these concerns that I might have about the operating environment? So that's a very live issue for home buyers. The other issue, of course, and that's not linked to the Bank of Canada, was that for new purchasers, so first-time home buyers looking to purchase a new house, there is now a GST cut available to them, which wasn't the case up until May 27th. Mm-hmm. So for folks that were looking to buy a house earlier in May, a new house, first-time buyers, new house, earlier this year, they effectively knew that if they waited, they'd be able to get a significant portion of GST rebated, maybe entirely rebated on them. So that's in play now. We'll see how the market responds to that, but that will probably give a little bit of a support to the market as we go forward, even if the Bank of Canada hasn't cut interest rates today.
Mm-hmm. What had we been seeing in the housing market? Were home buyers or would-be home buyers largely staying to the sidelines?
To a very significant degree, a very significant slowdown in sales, an increase in listings, of course, but a slowdown in sales as people are just on the sidelines. They're just waiting. They want to see what's going on before they make that big decision. Because, of course, as you know, for most people, buying a house is by far the largest expenditures they will ever make. And it's understandable when things are as bizarre as they are now for people to want to hold off a little bit until they feel a little more comfortable about their decision.
What is your main takeaway from all of this for Canadians from the Bank of Canada's decision and outlook?
The main takeaway is there's a tremendous amount of uncertainty. There's nothing new there. I think the main takeaway for Canadians is to not necessarily bank on lower rates going forward. It really is a dynamic situation. We hope the circumstances are such that rates can come down. We're not sure. At this point, we think maybe not. But a lot of folks out there do hope rates are going to come down. In fact, a lot of economists think rates are going to come down. Markets think rates are going to come down. Just be mindful of the fact that that is not necessarily what's going to happen, even though we dearly want that to happen.
Thank you so much, DF, for coming on to the show.
You're very welcome.
I've been speaking with Jean-François Perrault, the Chief Economist at Scotiabank. The Perspectives podcast is made by me, Armina Lagaya, Stephen Maurice, and our producer, Andrew Norton. The clip you heard in the intro was from the Bank of Canada. For a transcript of this episode, as well as other stories, insights, analysis, and thought leadership, visit our website, scotiabank.com/perspectives. We'll see you next time.